Welcome to this explainer. Today, we are completely rethinking how we understand cold, hard financial mechanics. Now, finance can usually feel pretty dry, right? But to change that, I want you to picture us stepping out onto a quiet terrace. Imagine a small brass hourglass with really fine sand sitting on a table. Its frame is carved with the word seme, which means time. Right next to it, there's a little packet of salted almonds and a printout of a bond valuation sheet. It's a pretty striking contrast, mixing the everyday with the economic. But it sets the perfect stage for our analysis today as we explore the rhythm of value. We're drawing from some truly insightful source material that asks a fundamentally brilliant question. What is worth, and when exactly does it arrive? Our source material introduces us to a thought from someone named Mira, and it's absolutely crucial. She says time is not just as passage, as presence. Think about that for a second. In finance, time is almost always treated as this completely passive element. Just a ticking clock or a waiting period to get through. But this idea totally flips the script. It challenges us to see time as a presence. It's about how value actively shifts and transforms when we consciously choose to wait, when we take a risk, and when we genuinely choose to believe in something. So let's dive right into our first pillar. Time is actually trust, redefining the wait. To really get this, we kind of need to toss out the standard financial jargon right now. We have to redefine value. Instead of just a return on investment, think of value as a relationship. In traditional finance, we're taught to look at value purely as the monetary reward you get at the very end of a transaction. But what we're learning here is that value is actually about the human connection you build through that transaction. When you look at it that way, taking a risk becomes a shared rhythm between people. Let's look at how this plays out in the real world with something simple, like standard early payment discounts. When a cooperative offers early payment discounts to its retailers, a 1,000 rupee invoice paid today is mathematically and practically worth more than that exact same 1,000 rupees paid next month. Now, they might not be throwing around complex financial terminology, but they inherently understand time. That early liquidity, it isn't just a clever cash flow trick. It's literally a measure of trust between the cooperative and the retailer. And this brings us to a brilliant real-world application, 8%. That's the discount rate a school used to justify the really high upfront cost of installing solar panels. They mapped out the savings they generate over 10 years and discounted them back to today at 8% to make their decision. By applying this math to future savings, they aren't just doing accounting, they are turning time into wisdom, proving that making an immediate sacrifice today builds a deeply sustainable future. You can see this exact same principle down the street at a local bakery. They decided to offer prepaid subscriptions for weekly deliveries. So customers pay a little less upfront, and in exchange, the bakery gets immediate liquidity. It's a total win-win. But more importantly, the bakery's prepaid subscription model shows us exactly how giving customers a discount buys the business something highly valuable right in the present moment. It proves time isn't just passively ticking away, it is being actively converted into mutual trust. All right, moving on to pillar 2. Valuation is a narrative. This is where math meets meaning. So consider how a cooperative issues bonds to fund something like a cold storage unit. They sit down and calculate the present value of 1,000 rupee annual coupons over 5 years, plus a 10,000 rupee principal at maturity. Ultimately, the bond is priced at 950 rupees. But here is the crucial point. When they price that bond at 950 against those future payouts, it is not just funding. It's literally an act of faith. Anyone buying that bond is buying into the future success of that specific cold storage unit. Or take a publishing house projecting its cash flows before partnering with a new distributor. They use a standard discounted cash flow. Basically, they estimate future money and reduce it by a 12% rate to see what it's worth today. But we can't look at this as just a sterile textbook calculation. When they use that 12% rate to value their brand, they are turning a business negotiation into a narrative. They are using math to confidently tell the story of their brand's future strength. And that specific math brings the publishing brand's valuation to exactly 15 lakh rupees. By anchoring their brand's story in this concrete number, they give their future potential real, undeniable weight and presence. It roots their entire narrative firmly in reality. Let's look at one more example of this. A startup examined market comparables, meaning they looked at similar firms and adjusted for scale, to arrive at an equity valuation of 8 crore rupees before going out to raise funds. Our source points out something really interesting here. This method wasn't perfect, but it was highly participatory. Valuation, as it turns out, is about looking around, seeing exactly where you fit into the market's broader story, and inviting investors to jump in and participate in that shared reality. This leads us right into pillar 3, balancing risk and purpose, or choosing hoped over hedged. Think about a bakery deciding to invest in a brand new line of millet-based products. From a purely financial, spreadsheets-only standpoint, the returns on this new line are totally uncertain. But they go ahead and do it anyway. Why? Because the risk aligns perfectly with their core values. They aren't just blindly chasing maximum profit. They are purposefully choosing a risk that matches their underlying purpose. We see a similar strategy at a larger scale with a cooperative's portfolio. Let's say it's spread across milk, curd, paneer, and flavored drinks. Some of these lines, like the flavored drinks, might offer way higher returns, but they carry significantly more risk. Others, like your everyday milk and curd, offer rock-solid stability. A successful cooperative doesn't just run away from risk, it balances it. By diversifying their offerings, they ensure they can sustain the business while still reaching for that higher growth. They actively manage risk through variety. And of course, it isn't just businesses making these calls. Think about a school's scholarship program that relies entirely on alumni donations. The returns here are purely social. There is zero financial kickoff for the school. The massive risk they take is in continuity. Will those donations actually keep coming in next year to support these students? But instead of hedging their bets and playing it completely safe, they choose to hope. They consciously take a calculated risk for a profoundly social return. Okay, Section 4, your relationship with value. Time for the final reflection. As the sand finally runs out in Mira's brass hourglass and the salted almonds are all gone, we have to turn these concepts inward. The source material leaves us with 4 incredibly powerful questions to reflect on. First, ask yourself, what does time mean in my decisions? Seriously, when you look at your own life and your own finances, is time just a passive passage you're wading through, or is it a possibility? Are you actively using time to build trust? Here is the second question. How do I value what I create? Are you measuring your worth merely in immediate transactional returns? Or are you valuing the long-term relationships and the deeper narratives you are actually building day by day? Number 3, what risks do I carry and why? Take a moment to think deeply about the uncertainties you've allowed into your own life. Are you just taking risks blindly, or are your risks, just like that millet bakeries, truly aligned with your deeper purpose and your values? And finally, what returns do I seek and how? Are you strictly looking for profit, or are you also seeking out social returns, stability, and human connection? Think about that hourglass on the terrace. Think about the relationships you're building. How will you measure your true worth tomorrow? I'll leave you with that to think about. Thanks for joining me for this explainer.